All right, well, hello everyone. My name is Dustin Kunkel and I'm with the Pikes Peak Small Business Development Center. I'd like to welcome you all today to the webinar called Sole Proprietorship, LLC or Corporation, Choosing an Appropriate Legal Entity. We're glad you could join us and we hope that you'll receive some great takeaways today as you decide how to structure your business for legal and tax purposes. All right, so very quickly, I'd like to introduce you to our organization, the Pikes Peak Small Business Development Center. Our center, along with over 1,000 other SBDCs nationwide, offers free consulting, practical training, and business resources to small businesses with help from the Small Business Administration. Our local corporate sponsors also include El Paso County, City of Colorado Springs, ConnectDOT, Minority Business Office, and Ent Business Banking. After this webinar, if you are interested in meeting one-on-one with an SBDC consultant or attending additional workshops or webinars geared towards small businesses, please visit our website at pikespeaksbdc.org to get started. Today's webinar will be recorded and you will receive an email following the presentation with a link to the recording. Additionally, in today's webinar, you will see an attached copy of the slide presentation. We encourage you to download a copy of that file before the end of the webinar. For those who may be watching the video recording of this webinar, you will find a link to the handout in the follow-up email. Okay, I have the pleasure of introducing today's webinar presenter, Steve Ogle. Steve is an attorney at Sparks Wilson, and he's an expert on small business and tax law. Because of Steve's tax education and experience, in addition to his practicing law, Steve has a unique perspective and ability to address both the practical, legal, and tax implications of each type of business structure. Steve has been teaching SBDC's legal entity workshop in Colorado Springs for a number of years, so we are happy today to offer his workshop in an online format. Steve will be sharing with us for 1 hour today, and then we will have a few minutes at the end to answer any questions you may have. Feel free to type out your questions during the webinar, but please note that we will answer all of them at the end of the webinar. So thanks for joining us, Steve. We'll get started here in just a minute.
Hello. Welcome and thank you for joining us. This is a new experience for me and I've just got this unblinking eye looking at me and sending you video. So bear with me as I work through this. I want to provide you guys today with a general overview of the different types of entities that you have to choose from and give you a kind of 101 survey of what those look like and the pros and cons of each. Since I'm an attorney, I start with a disclaimer, and the first part of that is that this is a limited overview. And so the idea with this is we're going to provide a general discussion to give you some background on the various entity choices that you have. Bear in mind that specific facts matter. So if you have a unique situation, even if you think you don't, you might, but if you have a unique situation, there could be some nuance or specific detail that would inform the decisions or the advice that I would give you in that. The other thing to keep in mind is that laws change. There are no big changes with state law coming down the pike right now that I'm aware of, but that can change fast. And then the tax law is always in flux. Maybe someday it'll get simpler and more standard, but for now, that's just not the case. So as we're going through the different forms of entities today, just generally up top, all of these are going to be governed by state law and the agreements that are entered into by the owners. And from simplest to most complex, we're dealing with sole proprietorships, which we'll cover first, partnerships, which we don't use much anymore. They're used a little bit in my estate planning practice, but what we find is that all of the benefits with a partnership we can now get with LLCs, and on top of that we stack all of the additional LLC benefits. So we aren't really going to talk about partnerships from a legal structure standpoint, although we will be talking about them from a tax standpoint. The third and most complex form of entity that we'll be talking about is corporations. If we have time, then I'll cover that in a little bit more detail, but I'm going to try and do a bit of a gloss over on the structure and organization of that, because I think for most of you that's going to be, it's good information to know, but it's not going to be as helpful when it comes to deciding if and what type of entity you should be. So the first one, the sole proprietorship, this is simply a single individual operating on their own. And so what that means is that there are no filing requirements with the Secretary of State, which is something that you find with the other types of entities. There are no operating documents that say what the rules are for the way that this business operates. And the downside of all of that is you don't get any liability protection. This is just you running your business on your own. And so this is a good idea for things like selling dolls on eBay, where there's not a lot of chance for real liability or exposure on your part, but it's going to be a bad idea for something like home building, where you're putting something together that's complicated, and if something goes wrong, it could hurt someone or it could be expensive to repair. And so when we talk about the concept of limited liability, that's what you don't get with the sole proprietorship. That's what you do get with the actual business entities that you register with the Secretary of State. And so the idea with this is that it's actually a separate entity from the owners. Even if there's one owner, it's separate. And the way that you achieve that separateness is by respecting the form. We call it respecting the corporate form, even when we're talking about LLCs. And the idea with this is that if you treat it as distinct from the owners, then you will be able to have that limitation on liability in place. So when you're looking at what respecting the form looks like, the first thing that you want to do is you want to maintain separate accounts. So if you have an entity set up that's operating your business, you should be maintaining a separate account for that entity. And you should be, when you're dealing with that account, you should be treating it as completely separate from your own personal accounts. So for example, if you want to go to the grocery store and buy groceries, you're going to pay for those groceries through your own account, not through the business account. You can still pay yourself through the business account, but you need to keep that separation so that whatever's going on with the business account is clearly related to the business itself and not for your benefit personally. You want to follow the rules of the governing documents, and we'll talk a little bit more about what those look like. But anytime you've got something like an operating agreement in place, then you want to make sure that the decisions you make and the actions that you take are within the framework of what those governing documents actually allow. The next thing you want to do is fund with adequate capital. So what that means is if you're going out and you're buying a bunch of equipment to start your business, what you don't want to do is take out a bunch of loans through the entity and then not have enough money in the entity to pay the debts as they come due. If you do that kind of thing, they will look past the entity to you individually for those obligations. And even beyond those obligations, it can actually undermine the idea that the entity is separate. So all of that is basically summarized with the idea that the entity is not an alter ego of you. It's not a flag of convenience that you raise whenever you want to make sure that somebody can't get to your own personal stuff. Instead, this is a separate being from you, and you have to follow the rules that are associated with that if you want the benefit of the limited liability. The last thing to keep in mind is that limited liability is in fact limited. And so what that means is you can still be on the hook for actions that you take personally. A big one that has been in the news lately has been with this opioid crisis, and there's this pharmaceutical company that has been in big trouble, and they're also going after the individual family owners with that. And so the reason that they're trying to go after the individual owners is because they did some stuff that is not limited to the entity itself, and so they may personally be on the hook with those things. So that also extends to your small businesses. If you're operating a food truck and you're driving the food truck and you're texting while you're driving, even if you have an LLC that runs this business, if you end up hitting somebody with that truck because you were texting while driving, then you personally can be on the hook for any damage that's caused by that. And so in terms of making sure that you get that limited liability, really the simplest way of getting that is through an LLC. It's a very easy structure to work with, and it provides a good combination of asset protection and flexibility. The way that you create one is you simply go on the Secretary of State website, and they've got a little drop-down menu for business organizations, I think, and you can go in there and file a new form to create a limited liability company. And they will run through, a series of questions that they have related to where it's located, who's the registered agent, and then is it member managed or manager managed. For the registered agent, it's easy enough to put yourself as that agent on there and your own address. For the member versus manager managed, what I always recommend is that people choose manager managed. And the reason for that is if you have a manager, then it's a designated individual who has the authority to take action on behalf of the company. If you're member managed, then what you're actually telling people is that a member has the authority to take action on behalf of the company. And so without any additional limitations in place, what you can face is the challenge of having to deal with a member acting in an unauthorized way, going out there and transacting business or selling some asset on behalf of the company that they shouldn't be able to do. And so the idea with the member managed is that's a little too much authority and it's too broad, whereas the manager managed will give specific authorization to a person, and the owners of the company, whether that's 1 or 10, are going to choose who those managers are. It can be one person, or it could be that 10 people if there are 10 members of the LLC. So in addition to filing with the Secretary of State, what I always recommend is that the members adopt an operating agreement. This is what really sets the rules for how the LLC will operate. If you don't have one, you fall back on the laws that were enacted by the state legislature, and they can provide a good framework, but they fall short in a number of areas in terms of limitations that you want to provide. And the other hazard that you face with them is it can be really difficult to interpret what the actual rules are. If you want to deal with legalese at its worst, you can go look at the statutes, and it actually makes me feel better in terms of what I've drafted, because I look at what I've drafted, and even if it's complicated and has legal jargon, it is nothing compared to the way that the legislature drafts things. So generally, the pros and cons of the LLC. The biggest one is that it's tax efficient, and I'll talk about that a little bit more in a minute. Liability protection is also huge, obviously. If you respect that corporate form, then you are going to limit recovery to the assets of the LLC. And so what that means is if the LLC owns a home and it's operating a rental property and somebody gets hurt in that home, then when they get a judgment to recover against the LLC, they're going to be capped at what they can recover based on the value of that home. Instead, if there isn't an LLC in place, what would happen is they would actually be able to go after all of the other assets of the owner as well. So no matter what you're talking about, whether it's a very small business or a very large one, you're going to be broadly expanding what any creditors could go after if there's no limited liability in place. The other benefit is the flexibility. The complexity that is built into your situation can easily be handled with an LLC, whether you're a single member or whether you have 20 outside investors. So it's a really good one-size-fits-all approach there. The only real con with the LLC is the filing fee. I think it's $50 with the Secretary of State, and then you have an annual $10 to keep it in good standing. And other than that, there really aren't a lot of downsides. You do have to respect the corporate form, but the benefit that you get for doing that in terms of the liability protection is so great that I really just think that it's a slam dunk on that one. So in terms of the operating agreement, like I mentioned, the LLC without the operating agreement is going to be governed by state law. It's going to be bad for multiple owners, especially because not only do you have to deal with the interpretation of what those laws all say, it's going to ignore any limitations that you're probably going to want on who an owner can sell their interest to. It's going to ignore the rights and limitations that you may find beneficial in terms of who is able to manage the company, who can transact business on its behalf. Often when we have multiple owners LLC, we still actually have one individual who is supposed to be running the show. And so if you don't have that operating agreement that shows who is in charge, then you can run into issues with different members doing different things, not communicating with each other. And even if they are well-intended, a lot of the times things can just get complicated and collapse on them. So when you have the operating agreement, instead what you can do is you can clearly define who's a manager. You can establish rules on what happens if an owner wants to sell their interest or if an owner passes away. And you can really shape the operations of the whole organization in a way that makes sense for you guys. And so in that respect, when you have multiple members especially, it is essentially a contract. And so when you're reviewing that, when you're deciding on what it should say, always pay attention to what it says. There's no such thing as a standard agreement or a standard language. It's really whatever you guys need that makes sense for your situation. So in terms of where you can get an operating agreement, the best place to get one for free that we've been able to come up with has been Pikes Peak Library District. They actually offer a number of different forms online that you can go and look at and find one that works for you. I haven't taken a look at them individually, but I understand that some people have vetted them and are satisfied that they're pretty reasonable and get across what most people are going to be looking for. If you have a more complicated situation, or if you're already working with an attorney, then an attorney can prepare one for you. Generally for me, what that looks like is if it's a single member LLC, it's usually going to be like 2 pages long, and they only go up from there in terms of the complexity that's involved when there are multiple owners. But obviously there's going to be a lot of cost associated with that. Like with a single member LLC, it might be a few $100s, but when you're getting more complicated, it only adds on to that. What I would definitely suggest you not do is going online and just Googling for operating agreements, because you will find all kinds of crazy stuff on there. And I promise you that there will be all kinds of issues that you didn't expect in those. So try and keep with some resources that you know have been sanitized when you're looking for those, whether it is an attorney or the library district, so that there's at least somebody's been looking over this thing and made sure that there isn't anything too crazy going on in it. So from a tax perspective, the tax treatment of an LLC is going to vary between single member versus multiple members. For a single member, it defaults to what's called a disregarded entity. And what that means is, for tax purposes, it simply doesn't exist. You can report it on your 1040, and usually that goes on Schedule C. Sometimes there's a little bit of variation there depending on what sort of operation it has. When you're reporting that, you are going to be hit with self-employment tax at 15.3%. And so what that consists of, it's the FICA taxes essentially. And typically when you're paid by a third party, that employer is going to be paying half of those. And so you're on the hook for the full amount because you don't have an employer, you are the employer. And in order to soften the hit a little bit, half of that is going to be deductible for you, which is normally what your employer would pay, but you will be on the hook for that full amount there. But really, in terms of taxation for a business, it doesn't get any easier than reporting it on the Schedule C. Even if you do have a separate tax ID number for the LLC, you can still report it on there. Sometimes you want to have a different tax ID if you're giving out that ID to other people and you don't want to be distributing your Social Security number, for example. When you have more than one owner, you default to a partnership treatment. And so a partnership, even though we're not going to talk about those from the entity standpoint, a partnership from a tax standpoint is just a pass-through structure. And so what that means is that the entity itself isn't going to be taxed on any of the income. Instead, it's going to flow through to the individual owners. And the way that it does that is the company is going to have to file a separate tax return. That's a Form 1065. And when they prepare that return, they're actually going to issue what's called a Schedule K1 to each of the individual owners. And the K1 is going to report each individual owner's share of income and loss, and then that is going to be filed with the IRS, and it's also going to be kicked out to each of the owners, and then they take that information and they use that on their own individual tax return. So the benefit with this is that each owner pays its own income tax rate and that there's no double taxation, which I'll talk about a little bit more in a few minutes on the corporate side of things. It is an additional complication because you are preparing a separate tax return for the entity, but if you have more than one owner, you really can't avoid that in any way. Keep in mind also on those services payments, there will still be the FICA taxes that are owed to the IRS from you individually. So that's something that doesn't go away just because you have multiple owners there. The other thing to keep in mind is that an LLC has the flexibility of being able to elect treatment as an S corporation or a C corporation. I'll talk about those a little bit more when we're in the corporate side of things, but I do want to point out here, so if you elect to be treated as an S corporation, make sure that you clarify to your advisors that you are an LLC still, if that's how you're set up, that has elected to be an S-Corp, and make sure that they know that you're an S-Corp. There are specific rules that are related to that, and if you don't follow those rules, you can end up blowing the election, which at the very least means that you're not getting taxed the way that you want to. And at the very worst, what it means is that you're actually going to end up with interest and penalties if you are somehow paying less in taxes than you otherwise would be supposed to. So here is a quick pair of charts that describes the tax structures for the LLC. On the left side there, you have the single member LLC or a sole proprietorship. They each work the same here. And what happens is as the income goes in, it actually just passes straight outside of that entity. And the idea there is because it's disregarded, it's like it doesn't exist, so it just flies on by and goes straight to the individual. Sorry about that. The LLC will still be there for liability protection purposes, but it just doesn't matter from a tax standpoint. So it goes to the individual and then it gets reported on their individual tax return. Then on the multiple member side of things, what you see is that instead of passing beyond the LLC, it stops there. The LLC prepares that Form 1065, and then it issues out those K1s to each of the members. So if member A owns a 20% interest in the company, then typically what you'll see is that they're going to get 20% of the profit or loss of the company as well. I say typically because there are sometimes variations on that, but that gets a little bit more complex. So the thing to keep in mind with this is once those K1s go out to the individuals, those individuals will be reporting on their Form 1040, and then that's where it goes from there. So the corporation is really the classic type of entity that that everybody thinks of, you know, Apple, Target. It's built for outside investors, and it's designed to rely on state corporation laws. When you see a lot of those, because they rely on those laws so heavily, a lot of the times you'll see Delaware LLC or Delaware corporations or South Dakota. There are a few states that are really heavily favored by corporations and investors. It uses a series of documents instead of an operating agreement, and those can get more complicated in terms of preparation and management. It's just more paperwork. It can, those alone get you basically to the same place that an operating agreement is intended to, but just because of the way that corporations are structured, they're broken out into different documents there. The default tax treatment of a corporation is as a C corporation, and you can elect to be taxed as an S corporation, but you cannot be a partnership for tax purposes if you're set up as a corporation. Keep in mind still, these are tax elections and not the types of entities. There is just corporation, and then within that you have the C or S Corp choices. And we'll talk a little bit about why you might choose one or the other. Generally, pros and cons. If this is a structure that you're looking for, you're wanting to be able to rely heavily on those statutes, typically for outside investors. This can be great for fundraising and that kind of thing that you're looking to do in the future. The shares make ownership easy to track, but that's again something that you can actually build into an LLC now. And the big one is that it's preferred by outside investors. So a lot of the times we have small businesses start as LLCs and then they look to make money or to raise money because they're looking to really grow, and they will actually find investors who will demand that they become a corporation. And so at that point they have a choice of doing that to get the money, or they can say no and continue as the LLC if they want to. From the cons, the biggest one is the tax structure. If you are a C corporation, you are going to be subject to double taxation, and I'll talk about that in a minute. Because of all of the documents involved, there is a greater cost of operation. You're probably going to have to rely more on an attorney to advise you on that aspect of things, and then you can't avoid the preparation of separate tax returns for the corporation. The management is also a little bit more complex. With an LLC, you have members and managers, and within those two groups, you will find the people who are running the show typically. With a corporation, you have officers, directors, and shareholders, and there are different types of authorizations that state law requires that a certain group approve. So maybe you need to get shareholder approval, maybe you just need the officer approval. So it'll depend on the circumstances there. The structural rigidity can be a detriment. It's often a reason that people are drawn to the corporate structure, but if you're looking for flexibility, then it's probably not going to be the right fit there. So as I mentioned, the default treatment for a C corporation is going to be, the default treatment for a corporation will be as a C corporation, which means that it's going to be hit with the double taxation. As any income comes in, the corporation is going to pay income tax on that. And then if it issues dividends out to the owners, then the owners will again pay taxes on that. And those dividends are going to be ordinary income, so it's not like a capital gain benefit that you have from that. You can elect to be treated as the S corporation. The big benefit to the S corporation is that it's a pass-through entity like a partnership, And so you avoid the double taxation, and there are no taxes that are paid at the corporate level. You have to worry about the restrictions on ownership and the classes of interest that exist with that. So with an S corporation, you can't have any preferential distributions or anything like that. And you need to make sure that all of the owners actually meet certain requirements. I'm not going to get into all of those there, but if that starts to raise flags for you guys, then just be mindful of that and look at that before you try to make the election to be an S-Corp. The big benefit, the reason that people look to S corporations is they like the limitation of the FICA taxes. And when you're earning income for services that you provide to the corporation, then you will be subject to those FICA taxes on an amount that is determined to be reasonable compensation for those services that you're providing. But anything in excess of that is actually not going to be subject to those FICA taxes. And so what that looks like in practice is if I am the CEO of a company and I'm making $100,000 a year to manage the company, but I'm also the only shareholder, and the company is hugely successful, say it's got $1 million of income, then my compensation of $100,000 a year is going to be subject to those FICA taxes. But if I take distributions of that other $1 million in income, then I am not going to be subject to that FICA tax on that. So that's about 7.5% that I'm actually saving on that $1 million. And so as you can see, that really starts to add up. The big question that always arises in those cases is, what is reasonable compensation? And the answer is, there is no clear answer. It's really a facts and circumstances test. What I always tell people to do in those situations is look at third-party arrangements between a business and an individual who performs services like what you're performing, and figure out, where do you fall on that spectrum? Are you looking to be aggressive in how you treat that compensation portion, or do you want to really toe the line and make sure that the IRS isn't going to be concerned about that? Because what they can do is, if they audit you and they come in and look and say that I'm that CEO who was being paid $100,000 a year, but the IRS comes in and they say, well, we've looked around your community and similar CEOs are earning $400,000 a year. Then what they're actually going to do is they're going to say that you owe the FICA taxes on that gap of $300,000, and you'll end up owing interest on top of the services that you're providing. Then that's great, and those distributions are going to avoid that FICA tax portion. One other thing on that, as I've mentioned, the LLCs can elect the S-Corp or the C-Corp treatment. If it does, you want to address that in the operating agreement. One, because you want to make sure that any owner is going along with that structure. And two, because you want that to be front and center for any advisor that you have, to make sure that they know what kind of entity you are, because not only is that going to affect the way that they're preparing tax returns for you, but it can also affect, like I mentioned, who can be an owner of the entity. So if you're an S-Corp and you're an LLC and you have someone in Canada who wants to be a member, well, if they join the company, then you will actually lose the S election because they're a foreign individual. So be mindful of those limitations, and always consult with your advisors if you're making those big kind of moves and you're an S corporation. So in terms of the tax structures for the S Corp and the C Corp, on the left-hand side there, you have the S corporation structure, and what you'll see is on this little line that's moving to the left, that's where there's the reasonable compensation for services, and that's going to be hit with the FICA tax on there. The other income that comes in is going to get reported on that 1120S that you're filing with the IRS on behalf of the corporation. And then if distributions are made to the owners, then those distributions will not be subject to the FICA tax. Do keep in mind, if the S corporation has income of $100,000 and it doesn't make any distributions, then in spite of that, the owners of the S corporation will still be subject to tax on their share of the interest. So what you'll usually find is that they're going to kick out at least enough to cover the tax burden that's associated with that. But that's just something that you want to be aware of if you're taking the S corporation approach there. On the right-hand side, you have the C corporation, and this is the big bad double taxation, which is a real thing. And if you actually run the numbers, you can see the impact that it will have on the pre and post-tax profits to the individual shareholders. So the corporation is going to file that Form 1120, and they are going to pay tax at corporate rates. And then once that's been paid, they can issue a dividend out to the shareholders. And any shareholder that receives a dividend is going to be taxed on that dividend, and that will be ordinary income to them. So there won't be any FICA taxes due on that or anything like that, but it will be taxed just the same as any old income. It doesn't get the preference of being capital gains treatment. So in addition to those, to the LLC and corporation, there are other entity types that I like to do just a quick run through of. And the goal with that is really to make sure that, that you know that these are out there and recognize that some of these might also be a really good fit for you. The first one is a nonprofit, and the key to a nonprofit is that there's no private inurement. And what that means is that instead of having individual owners who benefit from the profits that that entity has, instead they keep all of those profits. It doesn't profit to the individuals. Instead, that goes to whatever cause they were set up for. These types of entities are subject to state and federal restrictions, obviously. So you've got, if you want to be classified as a 501c organization with the IRS, then you can get the tax exempt status. You do have to file annual reports with that as well. For a lot of types of businesses, this won't work because they're not providing a service that's necessarily for a pure public good. But it can also work for a lot of businesses. So if you're setting up an organization that's designed to help veterans, you know, and you want to provide housing for veterans or something like that, then that may be a nonprofit structure that would work. You can still pay yourself reasonable compensation for the services that you're providing, and you can provide that veteran housing. It just means that at the end of the day, whatever's left over, it's not going to go into your pockets. It's going to go to the cause. And so that often resonates with people when they're looking to set up some sort of public good business, because with that tax exemption, you have the opportunity to really grow without the tax burden, but you are still able to compensate yourself. It's not like you have to live as a pauper. It's not like you have to work for free or anything like that. There's also a hybrid called a public benefit corporation that exists as a middle ground between the nonprofit and the for-profit sector. The idea with this one is that any of the owners of this public benefit corporation accept a lower return in exchange for the good that they're doing. The example that I like to use with this one is Patagonia. So Patagonia is a public benefit corporation. They donate a portion of their profits to environmental causes. And when somebody invests in Patagonia, I think it's privately held, but you know, it has a number of owners. And so whenever they invest in it, they can see from the operating documents, they can see from the type of entity that it is, that it's actually going to make these contributions. And that's good for them, because if they're investing at that point, then they have those shared values. And it's good for the company as well, because they can put that front and center, and they can say, look, this is part of our purpose. We don't want you to be surprised when we do this kind of thing. Because if you had Apple or Target out there that was donating a bunch to environmental causes from their profits, then what you would end up seeing is a bunch of angry shareholders. Because the difference is, when investors go into Apple or Target, they're looking for that investment return. They're not looking for what good the company can do. But if they've got a structure like Patagonia with the public benefit thing, then that's something that's clear from the outset, and it's just a good way of advancing those values for the corporation as well. In addition to those entity choice things, there are a few items that I like to talk about here. These are not related to the type of entity that you're choosing. They're just related to running an ongoing business. The key with all of this is, whatever type of business you set up, even if it's a sole proprietorship, this isn't a set it and forget it type of thing. You have to pay attention to the administration side of the business and make sure that you're remaining in compliance with the rules that are out there. The easy one of these is if there are changes in tax laws, especially if there are big changes, be mindful as these are coming through, because they can affect the way that you operate on a daily basis. They can affect when returns might be due for you or how much you owe. And so I think you're gonna probably see that as it's going on. Some of the other stuff is a little bit more under the radar. So there's conversion of entities. If you are starting off as a Colorado business and you decide to move the business to Utah, then you can't just go to Utah and form a new business in the name of the old one. I mean, you can do that, but it is a totally new business and it's not going to be related to the old one. So there are actually some steps that you need to undertake in order to make sure that the assets are transferred and that you are continuing to operate that prior business in the new state. The other thing to keep in mind is, if you are an LLC initially and you decide to turn into a corporation, or vice versa, there's a method that you can use to do that conversion. But when you're making those changes, you want to be really careful, because there are a number of tax and legal implications for that. The biggest one is, if you are a corporation and you switch to an LLC, then that's actually treated as a liquidation of the corporation. And so that can generate a really big tax hit for the owners of the corporation. But even if you're just doing LLC to corporation, there are all kinds of strategic decisions that go into that. It's going to be probably a different tax treatment. It will be governed by different documents. You need to get the approval of the owners. And so all of those kinds of things, you want to make sure that you've got that buttoned up before you do it. And so I'm not trying to give you guidance on what that should look like necessarily, but definitely be mindful that you should be talking to your advisors when you make the decision to go that route. With the sales and use tax, if you're located here in Colorado Springs and you are just, you're going to be limited to the local area, you're not going to be selling goods out of state, then you can really just focus in on what Colorado rules are. But if you're selling products that require the collection of sales tax, then you need to know when and how to collect those. The other thing to keep in mind with that is, if you have a product that you want to provide at a set dollar amount, say $10, then what you don't want to tell your customers is, I'm covering the tax, so you don't have to worry about it. There are actually state rules that prohibit a business from absorbing those taxes that are meant to be paid by the consumer. But instead, what you can do is you can sort of work backwards. So if you know that you want to end up charging flat $10, you can calculate backwards to figure out how much is the good that I'm providing, and then what is the tax on top of that to get me to that $10 amount. Also, make sure that you're collecting and returning that just in accordance with the state rules, because if you fall behind on that, or if you're not collecting it, they have ways of figuring out what you should have collected, and they can come and audit you. And when you get a big hit on a tax bill for that, it can hurt. So it always makes sense to just really stay on top of that. Don't fall behind. If you do fall behind, don't wait for the state to come after you for it. The interest and penalties is where they will really get you on that. And that can actually undo a business. So it's best to focus on getting that stuff paid up the way it's supposed to be. Even bigger than that one is the tax withholding that's associated with any employees you have, including yourself individually. So when you withhold from employees, then you are actually holding that money in trust for the IRS. The point of that is it's not yours, and you don't have any discretion over the way that it can be used. So the best way to treat that is it's not my money. It's in a completely separate place. When it comes time to pay that over to the IRS, then do it. Don't think about anything related to your business. Don't think about that new tool that you want. Don't think about, oh, well, if I pay this over, then I'm going to go out of business, because you will go out of business if you don't pay it over because of how hard the rules are. What they will do is when the IRS determines that withheld dollars haven't been paid over, they will come after you for what's called the trust fund recovery penalty. And they can go after owners for that. They can go after bookkeepers for that. They can go after any employees who were, in their discretion, responsible for putting that money back into the IRS hands. And when they discover that, it's usually years down the road. So they make their assessment usually right before the statute of limitations is going to run on that. And then they're going to go after whoever they think is the easiest to recover from. So if the business is no longer there, individually, the owners and those bookkeepers, everybody who's responsible for that can still be on the hook for that. And they will go after you individually, and they will hold you accountable. And in my tax practice, I've seen this come back to bite people, even people who were, probably not responsible in the way that the IRS was treating them as they were. And the dollar amount just becomes so burdensome so quickly that you can easily end up with 50,000, 100,000, even more that you owe to the IRS, even individually. And so the best way to avoid that is really just to go ahead and pay that over, collect it and pay it over immediately when it's due. Don't treat it like it has anything to do with your business, except that it's an expense that you have to pay first and foremost. So sorry that I was harping on that one for a little bit, but that's a really big one that I've seen do a lot of damage before. And so the easiest way to handle it, I think, is just with that bit of information there. One thing that I'll talk about a little bit that's not on here is the classification of an employee versus an independent contractor. Like a lot of the times people will say, well, I'm just going to 1099 them, so I don't have to worry about the withholding for employment taxes. Whether somebody is an employee or not is dependent on what's called a facts and circumstances test. And the state of Colorado has one, and the IRS has another. And each of them is going to look at all of the facts and circumstances surrounding the services that that individual provided. And so they're going to look at where they provided services, if they provided services to other businesses, or if they were only providing services to you. They're going to look at whose equipment they were using. Were they using their own, or were they using the equipment of the service recipient? there are a number of factors like that when you go through them, after you consider all of it, they make a determination, was this an employee or was it an independent contractor? And there's no restriction on how much weight should be given to each. It could be something where maybe there is a service provider who works from home, uses their own equipment, but only does the work for one employer. And with all of the other things in mind, the IRS can come back and say, well, that's an employee. The Colorado Department of Labor can come back and say, well, that's an employee. And so if they make that classification, then what that means is even if you were issuing 1099s to them, you're going to be on the hook for that share of withholding that was due for them. You're also going to be on the hook for things like unemployment insurance that you should have been paying into the state. And so you can actually get in big trouble with the state for that stuff. And they provide incentives to employees or people who bring this stuff to their attention, because they really want to make sure that people who should be classified as employees are classified as employees. So if you have any doubt, then employee classification is going to be the safer route. Inconveniently, it's also the more expensive and more burdensome route in terms of just the administration that's associated with that. So just in wrap up a little bit, the choices that you have here range from simple to complex. The idea with this presentation isn't to tell you what kind of entity you should be, but hopefully it's helped to give you a sense of what would probably make sense for the circumstances of your business. When you're looking at that, I think that the big stuff that you want to consider is what's the objective with the business? Is this a full-time job? Is it a side hustle? Are you going to scale this up? Is it really capital intensive? If you are going to need outside investors, when are you going to need them? And what sort of expectations will they have in terms of the business structure that you're looking for? Also keep in mind the potential for liability. Like I said before, if you're selling dolls on eBay, probably not going to be a high-risk business. So if you're running as a sole proprietorship, then there can be benefits to that because you don't have all of that administrative burden. But if you are doing something that has a customer, that has a potential for something to go wrong, for someone to be hurt, or even if it's not somebody being hurt, if there's a chance that when your product has a problem with it, that it's going to be expensive to repair or replace, then you need to start thinking about the liability protection aspect of things and the benefits that go with those additional burdens of compliance. The burdens, the hardest part really is, I think, getting up to speed on all of the administration that goes on behind the scenes in this stuff. Like I said, it's not set it and forget it. So you do have to continue making sure that things are organized and operated in a way that respects that corporate separateness. But at the same time, once you've got that structure in place and you understand the way that things need to be done within that, then it gets a lot easier. So there's that initial learning period, but then it's smoother sailing after that, I think. The other thing to keep in mind is that you're not in this alone. So you've got resources like the SBDC. There are all kinds of professionals. There are organizations out in the community, regardless of what sort of business you're setting up, that can really help you give feedback and provide input. What are they doing? And then you can start to digest that and figure out, well, what are these other people doing right? What are they doing wrong? And you can find your own path through that. So that's really, I think, it for me. I see that we still have some time left, but hopefully there are some questions that you guys have, and I'll be happy to chat until we get all of those answered. And then, Dustin, can I turn it over to you for that?
Yeah, so folks, if you have any questions, which I'm sure you do, let us know by typing out your question and we'll respond to them in a first come, first served manner. All right, looks like we have one. Steve, are you able to see those questions?
I'm trying to pull it up here. Is there a way to pop it up? I think I see a little bit of it. No, that'll do it.
All right.
Okay, so the question is, as a sole proprietor or an LLC, if I hire an independent contractor or a freelancer, do I send them a 1099 since I paid them to do the work for me, or would I just include it in my quarterly or year-end taxes? So the question there, it really depends on the amount. So you aren't responsible for issuing 1099s unless you've incurred more than, I believe the threshold is $600 right now in services from a provider. If you have received more than $600 in services, then you do need to issue a 1099 because not only are you then letting them know what they owe taxes on as a service provider, but that's a form of verification that the IRS can use to make sure that that the expense that you incurred was legitimate. And so they're going to look at the 1099s that you've issued in connection with that. Oh, there's some other questions up there as well. Okay, so here's another tax question for LLCs. If you maintain profits in the entity's account for capital to use for emergency needs, whatever comes up, is that considered income that will flow through to the individual owners? And the answer to that is yes, that is income. So even if you don't make actual distributions to the owners, since an LLC is going to be either a disregarded entity or pass through, any income that it sees is going to be reported by the owners in proportion to their ownership and the rules of the operating agreement. So what we typically see in those situations, what I typically recommend is that if you have multiple owners especially, then there be a provision in the operating agreement that says we will give a priority to making distributions to cover any tax burden that an owner incurs because of their ownership interest. So usually what that says is at the end of the day, when there's income of X, at least 45% or something like that is going to be kicked out to them so that they can cover their income tax obligation. Then anything that remains in there, the LLC is still able to withhold the rest of it if it makes sense to for capital purposes or for having an emergency fund. But then you also know that you don't have a bunch of crabby owners because their tax obligation that's associated with that has been paid, especially when you're dealing with individuals who that's their main business, that's their only source of income. It would be really problematic if everything were just withheld by the LLC and then the individuals have to pay their tax from other resources.
It looks like there's 2 or 3 more here. All right, Steve, as an independent personal trainer, can I use my equipment, et cetera, that I've been purchasing on my own and have that equipment considered as part of the entity as an LLC? I'm assuming an LLC would be the best way to go for an independent personal trainer. Thank you.
So yes, first of all, for any equipment that you've already purchased, what you can actually do with that is you can contribute it to the LLC if you want to. So that can be treated as part of your capital contribution instead of just putting money in a bank account that's held by the LLC. You can go ahead and transfer ownership of that equipment over to the LLC. That can have some benefits of its own from a tax perspective because of the way that you can depreciate certain equipment and whatnot. But you can absolutely do that. And yeah, when you're setting up your business that you're usually an independent contractor or something like that, where you own all of the stuff and then you're just sort of freelancing all of the services that you're providing, then having that all in one stop like that makes a lot of sense. There are other ways that you could arrange that. For example, you could actually have a separate agreement between yourself individually and the LLC where you are agreeing to provide that equipment. But as far as I'm concerned, that's overly complicated. I think when you're dealing with a small business like this, it just makes sense. Put the equipment in that's going to be used for it. And like with a personal training type of business, usually that's not something that's going to be too capital intensive to start up, because unless you're dealing with really complicated equipment, you are providing the skill set that you as an individual have, and then there might be some light equipment that you use on top of that. So hopefully with just a little bit of seed money and then that equipment that you already have, you're going to be in place that you can be up and running.
All right. Next question. You mentioned selling on eBay. What is the sales tax required?
So that's a good question. The sales tax that you collect from individuals, this actually also relates to the sales tax that is imposed by the states where the purchaser resides. So it's related to your presence in that state. And this actually ties back to just the general sales tax collection stuff. So if you are selling to somebody in California and you don't have a lot of stuff on eBay, then you probably aren't going to be required to collect sales tax on that. When they make the purchase and they actually receive the item, then they're going to be on the hook for use tax. And the use tax that's incurred typically tracks identically with whatever sales tax there would otherwise be. But that way there's an end source obligation that's associated with that, and you don't have to worry about collecting and repaying that to all these different states. If you are selling it on eBay to somebody who lives here in Colorado, then you will be on the hook for that sales tax. And so the same collection and remittance obligations would apply. The rules regarding out-of-state sales are pretty complicated, and I'm hoping that sometime Congress gets their act together and resolves it, but I think it could be a while. So until that happens, all of the states are on their own. What you actually find is that there's a really new Supreme Court opinion. It came out last year, I believe, that when you are making enough sales to a state, even if you aren't based there, you can actually be hit with the obligation to collect sales tax and remit it to that state. So it's a pretty high threshold generally. Most of the states that are imposing these kinds of obligations, it's usually something like, I think, 200,000 or so. But those rules are only going to become more popular, and you'll see them in more and more states. So as your business starts to grow and as you start seeing more and more customers in a particular state, you definitely want to be cognizant of what the rules of that state are, because I've seen this happen with even small business clients that you would think wouldn't typically be subject to those rules, where states that typically don't have big income taxes or that are otherwise just really hurting because of online sales these days are starting to go after out-of-state sellers. And so I've seen Minnesota, Kansas, Texas, where they will go after, first they'll start by sending you a questionnaire, and it's super friendly, and they're gonna be like, hey, how's it going? We just wanna know, what are you doing in Minnesota? Please let us know, because that would be terrific, thanks. And then you answer it honestly, or you don't answer at all. When they get those answers back, they will typically decide that you owe them a bunch of money in sales tax that you have failed to remit, and so there will also be interest and penalties on that. If you don't reply, then they are going to draw a series of inferences based on what they know about you, and what they've been able to glean from any customers you may have that are submitting information to them. And so once they start doing that, usually that looks even worse in terms of the sort of liabilities that you can have. So that's a really convoluted answer, but the simple version is if you're making sales on a small scale to people who live in a variety of states, then you don't need to worry about collecting and remitting sales tax to those states. When it's going to out-of-state purchasers, also keep in mind you are not collecting and remitting to Colorado, because if you're mailing it out, that means that they're going to be using it out of state, and then that means that Colorado isn't going to be entitled to any sales tax on that.
All right, any last questions? All right, one quick question for you, Steve. As you register your business, you're registering it for the state of Colorado. If someone uses that exact same name in another state, what happens next and who has the rights to that name?
So if you are registering in Colorado and there isn't anybody else using that name here, then, so first of all, if you try to register and someone's already using that name, then you'll find that out from the Secretary of State, because they'll let you know. If it hasn't been registered with the Secretary of State, then what you can run into is, was somebody using it before you, even though they didn't formally register it? And that can open up a whole other host of issues. If it's just another business that's in another state and they don't have any presence here, then typically that's okay. If you're starting to do business in that state though, so if you expect that you're gonna expand and have a broader presence, even if it's just something like distribution, then you can run into issues. That's been a problem that even breweries have had, where they come up with a name that's unique to the state, but then when they start trying to distribute in Arkansas or Maine, then there's a small brewery there that has the same name, and you can run into issues there. Generally though, I would say if you're planning on just setting up your business here and you don't have any plans for expansion, go ahead and get it set up with that name. And as long as there's something that's unique about it and you're operating it here, you'll at least be safe in Colorado. Then when you expand to other states, if there's an issue with it, you can address that at that time. That may mean not using that name in that state, or it could mean purchasing the name from that other owner.
Awesome. And you may have mentioned this briefly, but can you describe a little bit of what trade name and DBA are?
Sure. So when you set up a business, if you're forming an entity, you have your LLC name, which it could be Steve's Services LLC. But say that you want to be known just as Steve Services, or you have some other idea of the name that you want that is different. So you can set up a trade name, which is also referred to as a DBA, where even though you have formed a business with a different name, you can take over the rights to that DBA trade name, and you can operate your business under that name. Even if you're a sole proprietor and so you haven't registered as an LLC or anything like that, you can still register that trade name. And then once you've done that, you're gonna have the rights to use it in this state. And so that can be helpful, where if you are able to continue just as a sole proprietor, you don't want to do all of the additional separate entity type of stuff, but you do want to have a name that's out there, then it can make sense to register it, because once you've done that with the Secretary of State, it formalizes it and it gives you better rights and a clear history versus if you just start using it on your own. If you're using it on your own and you haven't registered the trade name, then you have the priority as long as nobody was previously using it, but you're gonna have to prove that, and you're gonna have to sort of maintain and enforce that against anyone else, including anybody who tries to register it with the Secretary of State. So it's just easier to register it. I think it's like a $10 fee or something like that.
All right, looks like no further questions. We're going to go ahead and wrap this up. We know that you'll probably have questions or may desire some more one-on-one clarifications. Totally understandable. This is only an hour, so there's certainly things that we didn't cover. So, but the good news is the SBDC, the Small Business Development Center Network, that's why we're here. We have free confidential one-on-one consulting. It's through the life of your business. So whether you're considering starting a business, like many of you, and you haven't yet registered with the Secretary of State, or if you're right in the middle of your business or you're planning to end it, all of the consulting is free through the SBDC. It's a great opportunity to get your specific needs met and questions answered related to your business. So the next step after finishing this webinar is for you to schedule consulting for your initial consulting appointment by registering at pikespeaksbdc.org/consulting. So Steve, if you don't mind clicking to the next slide there, we'll just make sure that's up. Can you click to the next slide? All right. Yep. So there you go, pikespeaksbdc.org/consulting to register for consulting. And we have a number of people here that are ready to help you on this topic as well as many others. Okay, thank you so much for joining us. And we look forward to seeing you at the next workshop or webinar. Take care, everyone, and have a great day.